In this video, I'm going to go over aggregate demand and aggregate supply as it pertains to our GDP, or gross domestic product. And as you can see, is that when we have our aggregate demand, that's a downward sloping demand curve. Just like when we have been talking over the past, week or so, when we went over a demand schedule or a demand line, and it was downward sloping. And at that particular point in time, I may mention there's an inverse relationship, right, between price and, at that time, quantity demanded. So as we said, there's an inverse relationship. As the price declined, quantity demanded increase. Well, when we look at the demand, or the aggregate demand as it pertains to GDP, the same process unfolds. There's an indirect relationship, right, between price and GDP. As we can see, if price declines, right, if price declines from $6 to $4, we can see that our GDP, right, will increase from slightly more than 200 to slightly more, we'll say something like 375. Now, when we look at aggregate demand as it pertains to price and GDP, we have some price level changes. And as you can see here, yes, as price declines, quantity demanded, or GDP, will increase. But when we look at the aggregate demand, we have to take into account three factors. What we refer to as the real balance effect. That simply means that as the price level declines, purchasing power increases, right? Just makes perfect sense. In other words, if our CPI, Consumer Price Index, declines, your purchasing power will increase because the dollars that you have in your pocket or in your checking account will be able to buy more. Perfect, right? Price level declines. That's what we mean by that. When we look at the interest rate effect, we're kind of looking at the decline in rates, and here it looks at encouraging investment. And this would be to corporations, right? In other words, when corporations see interest rates declining, they will have a tendency to go out and borrow money, and with that borrowing, they will reinvest in plants, equipment, or expand their business, and that will have a positive impact on GDP. And then finally, when we look at prices, we have to be mindful of the fact there's a international trade effect. And what we mean by that is domestic prices versus foreign prices. So if our domestic prices are cheaper than foreign prices, what do you think is going to happen? Well, we got foreigners coming in and buying our products. So if that happens, of course, it will expand our GDP. So once again, when we look at aggregate demand, there is an inverse relationship between price and what's going to happen to GDP. At the same time, we have to take into effect these price level changes are based on real balance effect, right? Price level declines, purchasing power will increase, will cause GDP to go up, interest rate effect, decline in rates, GDP should go up, and then finally, international trade. If our prices are lower than foreign prices, okay, foreigners will come in and they will expand their purchases of our goods and services. And just the opposite, vice versa, right? In other words, if our price levels increase, GDP is going to decline. If our interest rates are increasing, GDP will decrease. And if our prices are higher than foreign prices, it'll be just the opposite impact. So that's what we mean by aggregate demand. There's an inverse relationship between price and what's going to happen to GDP from a price standpoint. if we look at it, as we pointed out, when we looked at our law of demand, we said there are certain non-price factors that will cause a shift in our demand curve, either to the right or to the left. And it's the same thing once again when we look at our aggregate demand as it pertains to our GDP levels. So the non-price factors that will cause our so-called aggregate demand, GDP line, to shift to the right with an increase or shift to the left down here with a decrease are based upon three factors. The first factor is household and business expectations. And what this implies is that if we're optimistic about the future, I'm a household, I'm a consumer, if I think things are going to get better, job security, I'm going to get an increase in my salary, businesses are optimistic, the economy is going to be robust, so there's going to be that tendency to expand. So when we look at households and business expectations, things are going to get better. It's going to cause our GDP line, it's going to cause this aggregate demand line to shift to the right. If we're pessimistic, businesses are saying, man, we're going into a recession. They're going to pull back. They're not going to invest as much. That would cause the aggregate demand line to shift to the left to a lower level, and the consequences, of course, would be a lower GDP level. Aggregate wealth, domestic and foreign incomes, aggregate wealth. That simply means, hey, I'm making more money. Expectations, right, are good. Foreign incomes are rising. Domestic incomes are rising. Guess what? I'm gonna buy more, and that will cause a shift to the right. Vice versa, right? Lower incomes shift to the left. Government policy, and here I'm talking about government policy, which we will focus in on, I believe, in the next chapter. We're talking here about fiscal policy and monetary policy. Government policy as it pertains to the fiscal side, government spends more, which they have been. I mean, government spending is at really an all-time high for the first 5 months here of 2019. The highest level since, I believe it was 2009. Well, that's a positive. Because when we look at GDP, let me just digress for a second. When we look at gross domestic product from the expenditure approach, we have consumption, we have gross private domestic investment, we have government spending, and we have net exports. So here we're talking about government policy as it's based upon government spending as a component of GDP. Well, if they spend more, guess what's going to happen to GDP? So let me repeat that. GDP is equal to consumer expenditures, government spending, business spending, and net exports. And that's simply exports minus imports. So when those factors increase, if C increases, hey, you as a consumer, if you're spending more, if government spending more, business is spending more, and we're exporting more than we're importing, guess what's going to happen to GDP? And that's really what we're talking about when we look at government policy on the fiscal side, government spending. And going back to aggregate wealth, hey, if incomes increase, hey, domestic incomes, your income increases, that's going to be positive. That will cause for GDP to rise because, hey, you're spending more. And as a matter of fact, when we look at GDP, consumer spending amounts to almost 72% of that figure. So that's where we stand. With aggregate demand, non-price factors will cause a shift. And from the standpoint of, when we go back to aggregate wealth, we have the wealth effect. You know, when you look at the wealth effect, kind of what they kind of look at stock market. Stock market has been going up. The stock market has more than tripled since 2009, really, specifically from March 2009. That's the wealth effect. Hey, boy, my investment portfolio, my IRA, my 401k, man, do I feel good? Do I feel wealthy? Well, granted, it's just a paper profit, but still there's that wealth effect. I feel wealthy. I'm going to spend more money. On the supply side, we have an upward sloping aggregate supply curve. And hey, going back to law of supply, right? There was a direct relationship between price and what happens to supply. In this case, the aggregate supply curve is focusing in on our GDP. And as you can see here, what I've indicated, firms tend to supply more output at higher prices, direct relationship. And that goes back, as I just mentioned, to our law of supply. So, hey, if price level goes down, firms, prices are not as high as they once were. They're not going to supply as much. So when we look at non-price changes in aggregate supply, here we have the original, we'll say, aggregate supply curve. We have price on our y-axis and GDP on the x-axis. We can see we have three non-price factors: wage rates and other resources. Well, if wages go up and resource prices go up, we'll say oil prices go up and wage rates go up, guess what's going to happen? That's going to cause a shift to the left in aggregate supply. And that's going to have an impact to reduce GDP. So when wage rates and, say, prices of resources will cause a decrease, shift to the left in aggregate supply. Hey, if, say, resource prices go down, oil prices go down, or whatever other raw material prices decline, that's going to cause my aggregate supply to shift to the right and an increase in GDP. Technology and productivity of labor. That's the big one, technology. If we have if technology increases, new ways of doing things, robotics, right, is the big thing now. If we have machines whereby labor can produce more, that will cause a rightward shift in our aggregate supply curve. GDP is going to increase. And of course, just the converse of that, if we don't have technological changes or productivity decreases, our aggregate supply is going to shift to the left, a decline in GDP. And of course, labor supply and capital, labor supply. If we have a greater supply of workers, or workers have better skills, i.e. from the standpoint, hey, you're getting a college education, that's going to increase your skill level, that's going to make you more employable, that should cause and be positive for the economy. So we would have a rightward shift in GDP. Less capital, here we're more talking about the availability. Could be financial capital, or it could be our brick and mortar capital, would cause a decrease in aggregate supply. So this is a graphical overview of aggregate demand and aggregate supply as it pertains to our gross domestic product and those non-price factors that are involved in causing a shift in aggregate demand, and those non-price factors that cause a shift in our aggregate supply.